All right, welcome to the Big Skinny with me, Lou Basenese. We're here all afternoon long with plenty of laughs, no gaffes, hopefully. What's on the docket? Well, let me tell you, it's more AI. We got two more stocks to add to our top 10 AI stocks not named Nvidia. We got Tariff talk and Tesla tantrums, and the great, well-dressed tech analyst, Dan Ives. Man, I dressed up for him. I went opposite, black for Dan, but we're going to be talking about all this and more. We want to welcome you to the show. Want to invite you to join the conversation. If this is your first time with us, you're probably wondering, what is this all about? Well, first, this is a Choose Your Own Adventure live video podcast. You ask questions, we opine in real time with you, so don't be shy. Cue up the Pat Bennett's and hit us with your best shot. Stock picks, stock ideas, criticisms, you name it, we'll take it on air live. But what's the big skinny, you say? Well, Urban Dictionary defines it as insider information. We're not that. Also says it's truth or the most essential information. We are that. That's our goal and our aim here, to bring you through the noise and the clutter that's in the financial press. I mean, today we're going to talk about tariff headlines and more tantrums. What should you be doing with your portfolio? I'll tell you what, you should be buying some of the stocks we recommend. And I say that because we got news this morning of a takeover of Core Scientific, a stock we recommended here on March 27th, roughly. It was a Thursday afternoon, trading for about $7 per share, going out for more than 15. It reached as high as 18. So that's an 88% return if you don't have an abacus or a calculator handy. We're here the whole time to give you that kind of information. So the essential truths in this market, we do it in a very straightforward format. In fact, some people have called us the sports center of financial news. I'll take it. It's a huge compliment. I like to think of us as Dave Portnoy of pizza reviews, but for financial and investing news, because we do his whole similar one bite, everyone knows the rules. Ours are a little bit different. It's one headline that you should probably ignore, one chart that you should really pay attention to the data, and one investment insight that should lead you and your portfolio and mine to the promised land of profits. Because after all, if we don't make money, what are we doing here? Just having fun isn't enough. So along the way, we're going to do that for you, bring you one headline, one chart, one investment insight. We start that at the top of the show with what we call our rundown. Then we get to a market-moving guest, a pro, someone that I've either been a colleague or I've crossed paths with, because I know, first and foremost, that you got to be humble in the markets or you're going to be humbled by the market. So today we've got Dan Ives. We'll get to more of that. But along the way, again, want to encourage you to join the conversation. Don't hold back. We've got a lot to cover today. Jam-packed episode starting right now with this week's rundown. All right, back at you. Nothing like getting excited with a little Rocky running through the streets of Philly. Yeah, I'm a New York fan. I'm not a Philly fan. But hey, don't send me any hate mail. I've had some good experiences at Philly games and survived them. Anyway, what's in our rundown this week? I mean, these are the top headlines that you should be paying attention to. And the first one is tariffs. Smaris, are we talking about tariffs again? Speaking of Philly, should we cue up the Allen Iverson clip of we're talking about practice? Practice? We're talking about tariffs again? Yep. The markets are selling off a tiny bit on tariff news, and the mainstream media can't figure out. It's a bit of a head scratcher, because if we look at this, ever since March, maybe February, we've been talking about tariffs. And as the U.S. News reports here, economy enters the second half facing a tight Fed that won't budge, even though the president's nudging. Trump's tariffs that are still an unknown and uncertainty, but the stock market is surging. Why, oh, why are stocks surging while tariffs are still uncertain? Well, let me tell you why. Because the market's moved past tariffs, and you should too. If you haven't already, you're missing the boat. I mean, we covered it on the heels of the Liberation Day sell-off, that the last thing you should be doing is selling. You should be backing up the truck and buying, which you'd be vindicated doing. But let's look at the underlying market fundamentals. And while U.S. News and World Reports is scratching their heads, this market's ripping and roaring higher because, look, this is the tariff rate. I mean, you don't have to even make sense of this. It looks like an EKG for your heart, right? I mean, it's up, down, up, down, up, down, tons of volatility. It's settling out right now at about an 8.7% effective tariff rate. That is not an insurmountable obstacle for companies to get over. In fact, if you look right now, analysts are anticipating a far worse impact on companies than companies are. And now, specifically, FactSet data shows that analyst revisions for Q2 earnings have been very, very severe. They've actually lowered their guidance for Q2 earnings by 4.2% this quarter, right? That's more than the 5, 10, and 15-year average of revisions. That's right. Analysts are never on point. They're always got to revise upwards or downwards. And as we enter new quarters, they tend to revise downward and cast doubt on the results. But guess what? The companies are doing, the actual people behind the businesses that are going to have to report results. Well, we showed you this before, but let's show it again. S&P 500 companies, this quarter, after Q1 reports, 51 of the 500 companies raised Q2 guidance. That's right. They raised guidance in the face and into the teeth of more tariff pressure. So what's that tell you? The analysts are more worried. The journalists are more worried, but the company's got it figured out. And here's where we come to our chart that matters the most. You can talk about tariffs. You can talk about the effective rate bouncing all over like a ping pong ball because the president can't make up his mind. Is it 10%, 75%, 135% looking at you, China, or back to 10% and then delayed? Here's what we know. If you look at container shipments, these are booked and registered 20-foot increment shipments of goods coming to the U.S. The U.S. alone, we're almost back to post-COVID highs. Folks, if the tariffs were having an impact on commerce, these cargo ships wouldn't be going anywhere. They wouldn't be booked to go anywhere. They're defying gravity a la Michael Jordan himself, and that means we should move forward, right? The investment takeaway is the markets move forward beyond the tariffs. You should too. Don't get stuck in a wait-and-see mode to see what the eventual tariff rate is going to be, because the markets are a forward-looking beast. They always see past what's on the immediate horizon to the potential problems, and I've got news for you. It's pretty much smooth sailing. We got the BBB passed. The back half of the year has got good news coming, good earnings growth, good capital expenditures, and more resolutions on tariffs. So that's the first of our three things to be careful about following the headlines. The second one is FOMO or MOMO. We got the acronyms adding up here. Is this market being driven by fear of missing out, or is it momentum? Ask the journalists. Once again, I think they're missing the mark. They're showing that mega call option buying in the S&P 500 is really what's driving this market higher, that everyone's trying to, in a low-cost way, make sure that they're positioned if the markets keep going and hitting new all-time highs. But I'm here to tell you that it has nothing to do with FOMO. It has more to do with momentum. It's a powerful force in the markets, especially when earnings growth is accelerating, which is what we've been talking about for weeks here. We've been putting this onto your radar to pay attention to. And like I mentioned a little bit earlier in the show, analysts are negative, revising their earnings estimates lower at historically wide margins, but companies are raising their guidance higher. So we know, we talked about this last week. If you look at the S&P 500, large caps are getting ready to report a 7% and then an 11% growth in earnings this year and into 2026. Mid caps, it gets even better. And small caps, it goes from negative 11% growth last year to 18% growth this year and 34% growth next year. That's a chart we shared last week. So go check out that episode. It drives home the point on why we should be looking for small cap bargains in this market, why you should be playing this market, because the reality is we have more highs to come from here. It's not just a guess. It's based upon the fundamentals, right? Defying gravity. So what do you do about it? Look, Jack Bogle, the founder of the Vanguard Group, said it's really easy. Don't look for the needle. Buy the haystack. Just buy the market, right? And if you've bought the market on every dip, guess what? Dumb money's still winning against the smart money. We've shown this in different ways and fashions over the course of our 15 episodes to date now. The quote-unquote dumb money, me and you, according to Wall Street, has been buying every single dip. And if you look at the cumulative returns for doing so in 2025, it's some of the best gains we've seen in about 40 years, rivaling the dot-com era. Yes, the smart money doesn't look so smart after all. The average retail investor this year that's bought every single dip is up over 30%. That's right. That's not a typo. Up over 30%. When some hedge funds were flat or maybe up 5% on the year. So give yourself some credit. You know what you're doing. You're seeing through the headlines. My advice to you is keep doing it. Don't be blinded by the headlines, but at the same time, don't just blindly buy the averages and the indexes, right? I think this is a stock picker's market. because you're seeing disconnects in valuations, and some of these stocks that are running up to sky high valuations are not being followed by some other ones that are undervalued. We've talked about sectors where there's value, still in small cap, still in biotech, in energy. There's a lot of opportunity in this market. At the very least, stay invested. Keep your 401k invested in U.S. stocks. Don't buy that anything but the USA mantra we've heard before. But even more importantly, start looking for bargains, like the ones that we've been giving you in our top 10 AI stocks, not named Nvidia, and like we're going to keep bringing to you week in and week out. And hopefully in a few minutes, we'll get some from Dan Ives as well. Some good picks that can go up double, triple digits, potentially in a market like this. That's the kind of market we're in. We're regularly seeing companies, CoreWeave up from its IPO over 300%, Core Scientific up over 100% since we first started talking about it. Folks, there is opportunity everywhere. Don't sit back and wait and see. Now, rounding out our rundown is robo-advisors. Now, is this something maybe you remember from a few years ago that rolled out where they were going to automate financial advice and charge a tiny, tiny, tiny sum to let these computers tell you where you should asset allocate? No, I'm talking about the humanoid robot wars, right? Everyone's advising you to get into robotics stocks right now. In fact, Yahoo Finance with a headline here saying among the best robotic stocks to buy according to millionaires. I think this was actually a syndicated column from Insider Monkey that was looking at purchases in the humanoid robot space by billionaires that are required to file with the SEC their positions, and they found that Tesla was on the top of the heap. Folks, I don't think Tesla is the best way to play humanoid robots. Newsflash. In fact, I think we're going to have a debate about that in coming weeks here. And let me tell you why. How many consumers have robots in their homes that aren't the iRobot Roomba vacuum cleaners? None. A big fat zero. How many are coming and when? Well, let's listen to Amazon, who could have been on the forefront of this robot trend. They did release a robot that they haven't done much with. Andy Jassy sharing in an episode, an interview with Jim Cramer. I think that many, perhaps most consumers will have robots in the home sometime in the next 10 years or so. How many people here want to wait around for 10 years? 10 years ago in 2014, what were you doing? I don't even know. At 47, I can't remember that far back. But here's what I can tell you. What's happening right now, and this is indicative of every tech trend, is commercial and industrial uses take off first and fastest. Look at Amazon. Andy Jassy saying, yeah, we're not going to really get into consumer robotics. Everyone's going to have them eventually in a decade. You know what Amazon has right now? Industrial robots. If you look at it, the number of robots working in Amazon's warehouses almost eclipses total employees. We're on that trajectory here. We're seeing a huge increase. This coming from ARK Invest, good old Kathy Wood, showing us that, listen, robots are replacing humans in Amazon's warehouses. This is where I want to profit from the robot trend. My robo advice to you is buy industrial and commercial robots. Ignore the humanoid robot trend. But you got to find ways to do that. We've mentioned two of those names here. We've got Teradyne, Symbotic. Is it Apocalypse Now or Portfolio Payday? It depends how you play this trend. I say it's Portfolio Payday with industrial robots. It's Apocalypse Now if you're buying Tesla, hoping, praying to the altar of Elon Musk that he's going to figure out humanoid robots and we're all going to have these Optimus robotic thingies that were staged during their demonstration, mixing drinks and messing it up. So anyway, I digress. That's with this week's rundown. We're going to get to our first guest next. But before we do, we want to make sure you're signed up to receive our insights every week. So make sure you sign up for our newsletter at thebigskinny.com. You can scan the QR code on your screen or visit thebigskinny.com. You might notice the website's in the middle of an upgrade in a good way. Let us know what you think, too, and don't be afraid to join the conversation. Now this. Do you believe everyone, I mean everyone, deserves access to quality healthcare, regardless of their financial situation? I hope so, because at the Roberto Clemente Health Clinic, we make that a reality. And I say we because I'm on the board of directors and have been for the last 3 to 4 years. I've been involved with the organization for over a decade. And if you didn't know, we're a US-based nonprofit that's dedicated to providing affordable, compassionate medical care to a place that I love as a surf spot that's also grown in my heart as a great place to visit with a great culture and great people. It's in Nicaragua, in the Tola community that has about 30,000 people in the second poorest country in the Western Hemisphere. And this is their only access to medical care. Now, I've seen firsthand the profound impact the clinic is having on lives, providing a full spectrum of medical care we take for granted here in the U.S., like primary care, pediatric care, urgent care, and just wellness education and other services. I encourage you to take a look at the nicaclinic.org. All donations directly support our mission, allowing us to continue offering these vital services. I know a lot of organizations clamor for your attention and your dollars. I'm just asking you to give it a consideration. Scan the QR code on the screen or visit nicaclinic.org to learn more and consider making a contribution. That's nicaclinic.org. Together, we can build a healthier, stronger community for those in need. We'll be right back.
How this sort of plays out is kind of branding. And what I mean by that is how much time we spoke on this show with analysts who, when Musk was tight with Trump, they were saying, oh man, that's a bad move. Yeah. You're alienating so many Americans. There's Sheryl Crow. She's selling the Tesla. She's so upset, donating the proceeds to NPR. She's not going to have it. But now you upset Trump. Yeah. So how do you think through the branding, the marketing, the implications?
Listen, even the best soap opera writers couldn't write one with more drama than this. True. I think you guys are being a little bit more diplomatic. I mean, these are two megalomaniacs with a lot of money that can't keep
They're just confident. I thought we agreed it was confident.
Okay, well, I'll go with that. Merriam-Webster had a different synonym for me, but they can't keep their fingers off the keyboard, really, right? I mean, Musk, to your point earlier, everyone wanted him out of politics, out of the government. You're interfering. Focus on the business. He gets out, extracts himself. Tesla goes on a great rally. The fundamentals start kicking in, and now he re-engages. So I think, look, he's operating under all press is good press right now. He's a solution. I don't think he can help himself, but I do think, as a shareholder, I would stand back. I'm not a shareholder. I don't bet against Musk, but I don't love Tesla. As a shareholder, I'd want him to be 100% focused on what's going to drive the business, and that's not EVs. I mean, you talked about the delivery report tomorrow. Not good expectations. It's humanoid robots and self-driving cars. That's the future of Tesla, for it to live up to the valuation that it's got, roughly $1 trillion market cap, right? So I don't know. I know both of them have advisors that give them good advice in both ears. I don't think they ever listen. So I don't know that us opining here will get them.
I wouldn't call those two of the more advisor-heavy folks that we've got out there in the world.
Right.
All right, welcome back to the Big Skinny with Lou Basenese, and I'm not going to waste any time bringing in this episode's first guest, and probably the biggest guest that's in the tech world. I don't say that lightly. I have no doubt you've heard his commentary, but now you get to hear it firsthand as our audience. Let me welcome to the show for the first time, Dan Ives, Wedbush Securities, Managing Director, coming to us. Are you in a robo-taxi? Please tell me. That would be epic if you're in a Waymo.
I'm not. I'm in a regular car.
Come on, man.
Sorry to disappoint.
No disappoint, man. You can never disappoint between your attire and your tech insights.
But in the future, it will be, hopefully.
Yeah. How far off do you? This is great entree into Tesla, right? Like the promise of Tesla now, self-driving cars, maybe humanoid robots right after that. But how close do you think we are to that future of self-driving cars?
I mean, look, like our team, we were down in Austin, we saw the robotaxis front and center. Look, it's my view, in the next 5, 8, 10 years, like it's a physical AI future in terms of robotics, in terms of autonomous. Look, and I just, you talked, I heard you right before, you're like, 10 years ago, like what was I doing? Like, I think in 10 years, that's really the future. And look, and it's why we're so bullish on tech and overall AI in terms of where we see everything heading.
Yeah. No, look, I think it makes sense. I think you're right. We're laying down the software layer and the chip layer for AI to penetrate the physical world. Who do you think gets there first? I mean, is Tesla the first one that really deploys it at wide scale for consumers, or do you see someone coming behind that's unexpected, right? There's an enabler that we're not thinking about in the big tech names.
Look, I think from a scale and scope, Tesla's going to be the one. Because look, Waymo, if you just think about it, like just how expensive those cars are in basically 5 cities, it's going to be hard for them to scale.
Yeah.
So Tesla will be the autonomous, what I view as leader. But others are going to be in as well, right? Like when you look at like Uber, how does Uber play? You'll see other OEMs that they play as well. But the physical AI future, like it's not a matter of like when, like it's happening. It's just happening. A matter of how. Yeah.
And so, I mean, I think you bring up an important point. It's not a zero-sum game, right? It doesn't mean like AI chips, Nvidia isn't the only winner in that, right? AMD can still have a really good market. You see the same thing in robots and the physical AI, that it's multiple players can scale really well and multiple investments can work out.
Look, I think Nvidia continues to be the core play.
Yeah.
Because look, there's one chip in the world fueling it in terms of the AI revolution, but AMD, TSMC, Broadcom. I mean, the point is like there's other ways to play, and that's why, I'm a big believer in like you have to look at like the second, third derivative
Yeah.
beneficiaries of AI. Yeah, I mean, you're pulling up the ETF. It's like we talk about in the Ives AI 30, like that's my whole view. Like my whole view is that we are in a fourth industrial revolution, and it's not just about one or two stocks.
Yeah, no, I totally agree. I mean, I think you use the right term that I've used to thinking about it in second and third derivatives, right? There's the obvious first mover, first winner, but then what are the next plays that start making it from there? I got one for you. Today, someone's out talking about, I can't remember what analyst it was, saying that we should rename a new Mag 7. We should kick out Tesla, which I know you love, and Apple, which I've always loved. I've been an Apple fanboy. So this boy band is breaking up. Mag 7's getting broken up. And in replacement, bye to Tesla and Apple, we're bringing in Oracle and Broadcom. What do you think about that?
I mean, look. My view is Mag 7 as an install base and just as a broader, as a broader sort of subsector. Part of the reason that it's always going to be Mag 7 is like, look, you could be a hater or lover of Apple or Tesla, but the scale of Apple,
Yeah.
it's unmatched. Just because
2.5 billion
2.4
right
billion,
now? 2.4?
exactly 2.5 billion, let's say close to 1.6 billion iPhones. Tesla, like when you're selling 1.7, 1.8 million vehicles, you have 10 million vehicles out. If you think about it since inception, but I'm a huge bull on Oracle
Yeah.
and Broadcom. So I don't see like I view it as like it speaks to my whole thesis. Like every dollar spent on a Nvidia chip, there's an $8 to $10 multiplier
Yeah.
across
No, that's a
the
good way
rest
to
of the
look.
tech
So
ecosystem.
it's not pick and choose. It's all of the above with these names that have established leadership in different ways and new products that are coming to market.
Yeah, and I think you could play it different ways, but I just personally believe like it's why Palantir has obviously been one of our favorite the last few years. Like
Yeah.
it's because I think like the
Confession, I
use
have no
case,
idea what Palantir does exactly, but it's a killer stock, and
but
it's
they know what you're doing. No, but I'm saying,
no,
but
no,
it's
dude,
like
that's exactly it. They've known for a long
they
time,
know
man.
what you're doing.
That's right. Hey, let me get this. I get a lot of flack for talking about Apple's 2.4 billion installed device, saying they don't really need to innovate terribly much. They can just iterate because that's such a big network effect. If you get an incremental margin over 2.4 billion devices, it adds up pretty aggressively. What do you think to that? I mean, do you think I'm off base there?
Look, I agree partially with it, and that's always been our thesis. I do think when it comes to AI, like you cannot be on a treadmill because it comes down to like the technology revolutions happen so quick. Apple just can't sit there as a toll collector
Yeah.
because of the developers. Because developers have choices: OpenAI, Microsoft, Google, and others. So that's why this is a very important time for Apple to really focus on when it comes to AI, whether it's perplexity, whether it's partnerships.
Yeah.
You cannot stay on the treadmill.
So do you think let's bridge the gap there, because I think Apple's analogous to Meta, right? In a different, like, Apple's not acting yet. Meta's saying definitively we're going to spend aggressively to develop our own platform. I don't know. I mean, would Meta be served just using one of the ones that's existing? Like, how frontier AI model do you need to run advertising, right? I mean, or is Meta trying to do something that we don't fully understand yet, that they're going to
Well,
spend
yeah.
this money?
Well, because like you could say it's like a wartime CEO type thing. Zuckerberg is focused on like full stack,
Yep.
right? Like in other words, and I think that's sort of the difference is that like when you look at Meta, okay, you could say stocks like had a great run, it's expensive. But I could argue when you think about true AI from an advertising perspective, if he's successful and the team's successful, then this is a four-digit stock, I think, conservatively.
Yeah, it's funny. It's the big if, right? Because he invested and incinerated about $38, $39 billion on the metaverse. He wasn't right. So again, I'm a little hesitant to trust it here, but at the end of the day, though, to your point, AI is the fourth industrial revolution. He's got one hell of a tailwind at his back with everyone else investing versus the metaverse, which was really, he was a lone soldier on that war.
Sure, and to your point, look, you're gonna have some misses like metaverse, but it all and like what you talk about with Apple, I think it also comes down to install base. That's why Oracle's having the run it's having. That's why IBM's having the run. That's obviously Microsoft. So I think install base is so important when you think about what's happened specifically on the enterprise when it comes to AI.
Yeah. What are some other names that you think that people like? I look at TSMC, right? Like Nvidia's got a monopoly on AI chips. TSMC has a monopoly on every chip because they make most of them. What are some other names that you think people just lose in the shuffle? They get so focused on Mag 7. We talked Broadcom, which had its roots in mobile. Is there another big tech name that you think really deserves more people's attention that doesn't get the headlines?
I mean, well, look, first of all, I mean, my view is like on software, it's Palantir, it's Snowflake, it's Datadog that we'd be a huge fan of there. I'm a big fan of like cybersecurity names because as you think about AI protecting on the cyber side, Palo Alto, CrowdStrike, Zscaler, or CyberArk, I think are very, very important.
Yeah.
Look, and it's like that's where this is all heading. It's about the derivatives that's all now starting to play out, and that's why I think like this is a market, despite whether it's Fed or just broader headwinds, geopolitical. I think the path's higher second half of the year for tech.
No, I was encouraged to see you say that for 10 to 15% higher in the second half of the year. I completely agree because everyone's overly focused on potential inflation, but not the deflation from tech and the growth that's coming from tech. It looks like you might be going through the matrix right now. So I'm going to talk through this.
Yeah, I'll be in a tunnel. So little matrix.
Yeah, so
But
I love it, man.
I was going into the AI sphere.
Yeah, I love it, man. Through the AI sphere, through the thick and thin. This is a man that's committed to his craft, gets on a live stream even in the middle of a commute, and I appreciate that. With that said, I want to give you a chance. You just launched a new ETF, right? It's the Dan Ives AI Innovation ETF ticker.
Yep.
I love it, dude. You've completely made yourself famous forever. You got your own ticker. I don't think lose would work. LOUS would not work on the NASDAQ. Ives works way better.
LOUS. It could. I mean, yeah, that could. Like LOUS. I like it.
Yeah.
It's
so tell us about it and how
thanks, man.
what came
It's
to it.
look, I mean, the origin is like I wanted a way for like investors around the world that follow us that can invest in AI and the broader theme, the fourth industrial revolution over the next decade. And this is all based on our Ives AI 30, the 30 names that we identify in our research reports that we view as the second, third, fourth derivatives. And if it's not just about Nvidia and Palantir, Microsoft, and others, and it's a dynamic list, right? Every quarter we could change who comes in, who comes out, and we've been excited. It's in terms of the adoption, and I think everyone's been very excited about it because they understand the theme. And that was really the origin of it because it's so important for investors, whether it's retail, institutional, whether they're in Australia or the US, to play a theme like that. And this gives them the opportunity.
Yeah, I love this because it's democratizing access. But even more importantly, I always advocate with cyber using ETFs because it gives you a dynamic as opposed to trying to pick like the silver bullet solution, which most of us are really bad at. Like you're talking about, how often is this dynamically adjusted? Does it
every quarter? Every quarter, and it could stay the same 30 or other. It could be 3 in new ones, 3 out, but it's all based on a research, right? Like so, over 3 million air miles the last 25 years. It gives investors the opportunity to like, this is what we do, right? It's what we eat and breathe in terms of the AI revolution and tech, and it's really to put together a vehicle that investors could play the AI theme.
Yeah. Listen, before you disappear into the AI sphere again, I got to ask you about Google, Alphabet. I've loved it because it's one of the most cheaply valued big tech names, still growing strongly, trading 18, 17 times forward earnings. Do you think that's a deserved valuation because of the regulatory risk, or is it an overreaction by the market and that they'll have their day to shine again?
Yeah, look, I think that it's getting overly discounted here. I think that Salesforce and Alphabet to me are probably the two most attractively like large cap tech names. But because of regulatory, obviously, in terms of the trials, I think worry about like AI and search, what that's doing. But the most AI engineers like in the world, you look where a lot of them, it's at they're going through a kind of glass half empty penalty box, but it's a name we think like this stock that has huge upside over the next like 2-3 years. They just need to get through this period.
Yeah, I agree. I think we have a chart. We might be able to pull it up. It kind of maps out the big tech based upon earnings growth expected over the next 3 years and current valuation. And Alphabet's sitting there really in the sweet spot. Not richly valued, but strong earnings growth. Dan, before I let you go, I want to just any closing thoughts. I want to thank you, but any closing thoughts you care to share with the audience?
I mean, look, first of all, congrats on this. This is awesome. Everything that you do, and I listen to all your stuff.
Thanks, man.
And I would just say, look, it's a fourth industrial revolution, okay? And I think as an investor, it's very important sometimes to like understand where the themes are going. And I think right now we're kind of going into the software phase. And the consumer phase hasn't started, and the autonomous and robotics phase hasn't happened. But I think I overall think market is underestimating what growth is going to look like in this fourth industrial revolution.
Yeah, I love it. Listen, I want to have you back on, but next time we're going to do tech analysts in cars talking about stocks. Like Jerry Seinfeld will be riding in a self-driving robo-taxi.
I like it. Love it.
All right, man. Well, hey, safe travels to you. Thank you again for joining the show.
See you.
Always appreciate it. Everyone, take a look at Dan Ives' new ETF. Like he says, it's a dynamically adjusted ETF, adjusted every quarter, so it keeps you one step ahead of the changes in the markets coming from insights that you're probably not going to get anywhere else. And I can say that confidently, even as a tech analyst that's been plying my craft for 2+ decades in the markets. You got to know where you can get an edge, and Dan Ives and his ETF can help you get an edge. I think if you look at the holdings, it's going to be companies you most likely know, the majority of them, but it's really about the nuance of knowing when to lean into some, to tactically allocate more to one and less to another that could really benefit you. So again, I thank Dan Ives for his time. We encourage you to check out his ETF. We also encourage you to check out thebigskinny.com's new website. Let us know if you find any bugs that need to be fixed. We just kind of upgraded it, I don't know, an hour ago. So we like to build things while we fly, and we'd love to hear from you. But make sure you're signed up for the newsletter at thebigskinny.com. Scan the QR code on your screen. Join the conversation. I want you, on a break here, think of one question you wish I would have asked Dan Ives, and jump in, let me know, and then I can have regret for not asking him. But we'll see you right back after a word from one of our sponsors. Attention investors, are you looking for a high growth opportunity in the energy sector, which is the most undervalued sector in the S&P 500, which we've covered here a bunch? Well, look no further than my employer and Prairie Operating Company. Trades on the NASDAQ under the ticker PROP. It's one of America's premier high growth, low cost oil producers that's making waves in the DJ Basin in Colorado. That's not the Permian, that's the DJ Basin. With a recent transformative acquisition, they've expanded their footprint to over 55,000 net acres and increased daily production by over 25,000 barrels of oil equivalent. Prairie is poised for strong growth while maintaining a strong balance sheet and delivering value to shareholders. So don't miss out on this exciting investment opportunity. Prairie Operating Co., PROP, on the NASDAQ. Full disclosure, I work for Prairie. I'm heavily conflicted, but conflicts of interest are a good thing. It shows you where your loyalties lie. But also remember, past performance does not guarantee future results. Make sure to consult your financial advisor before investing, and we'll be right back.
Are you worried about Tesla? What's going on with the company?
No, Elon Musk is probably worried about it. I mean, I think it's richly valued, the declining sales in a market that's seeing growth elsewhere. And then, look, the future for Tesla and the believers in the stock is humanoid robots, and they only have 16 patents there, where Sanctuary AI has over 277.
Wow.
So I think this is a tough road ahead for Elon. He probably should stay out of the politics and keep focused on the business. But
I think
he will prevail if anyone can.
I think the shareholders share that sentiment.
Um,
You bought some couple of stock picks with you, didn't you?
I think so.
Today?
It's a
I want to
requirement,
get to those. Well, it got you in the door, so tell me about them.
Yeah, Sport Radar. Everyone loves betting on sports betting.
Okay.
We've had some good success with Flutter, up about 80% since we recommended it here. Sports Radar is actually a technology and data provider to all the sports betting platforms. So instead of trying to pick or bet on the one sports betting platform that's going to win, this one services them all, growing at about 20% per year, and future growth expected to be the same for the next 5 years.
We'll have to leave it there. Maybe we can get the next one in.
No problem.
Thank you, Lou.
Welcome back to the Big Skinny. Man, I got to appreciate Dan, man. He was in a car traveling, joins us, has fun. This is a man that's committed to making sure his insights get out there, and we're committed to the same thing too. And we've been bringing you our list of top 10 AI stocks not named Nvidia. And I've got to, look, we got a high five. We got a section later in the show we can high five, but I feel like we got to high five a little bit here too. I want to know how many people, send us an email, info@thebigskinny, or chime in the comments. How many people here bought Core Scientific? Because it was one of the stocks we featured early in our shows and then added to our list. That's up more than 50%. Depending on your buying time, you could be up over 120%. But we want to know the value that you're deriving, because that's what this is all about. So our top 10 AI stocks not named Nvidia was built upon the philosophy that Dan Ives articulated about second and third derivative AI plays. Nvidia is a core position for everyone. I even joined the party late, buying shares in the last year. If you're late to the party, you can still enjoy some profits, right? But if you're earlier to the next wave of the party, you can enjoy a lot more. So that's what we put together our top 10 list for. It was predicated on the fact that, as we've been saying, that everyone is underestimating the amount of spending on AI. We've shown the charts. Some of the data points that really drive this home involve the fact that Q1 GDP growth in the United States was a negative 0.5%. It would have been a negative 1.5% if it wasn't for a full percentage point of growth coming from AI. That gives you an idea of how much spending is going on. And it's not just the first quarter, it's going to be throughout the rest of the year. In fact, Meta, as an example, even though I like to pick on Zuckerberg, he's going all in on AI, so much so that he's spending more on AI capital investments than he makes in that Meta makes in the trailing 12 months in terms of net income. Think about that. Think about taking all your take-home pay and putting it into AI. That's making a huge bet on the future, but there's not the only one. Amazon's doing it, Alphabet's doing it, Microsoft's doing it, and the list goes on and on. So this is one of those trends that can transform your wealth. If you look at McKinsey, if you want a consultant's opinion and not Lou Basenese's, a lowly tech analyst, they say that spending on AI infrastructure, specifically follow the darker blue here, needs to increase 3.5 times between this year and 2030, right? So that's a huge amount of money. We're talking about close to $2 trillion if I do the back of the napkin math real quickly. So again, when making investments, you can be contrarian and be invested in areas that are unloved, undervalued, and underappreciated, but you can also make a crap ton. That's the technical financial term of money by riding the trends, finding the trends that are going to persist through any economic malaise or upticks or downturns. Smartphones were the greatest example. Now you see AI, and it's broadening out. To Dan Ives and to my point, this is not just about a handful of AI names. You see here this chart from Yahoo Finance showing that the growth is really translating to names like Palantir, which, yes, I have no idea what Palantir does. Maybe we'll have a few guests on to try and explain it to us. Guess what? They don't have a clue either. But you're seeing other names, AMD, Dell, Avago, which is Broadcom, Oracle. It's really branching out. So this is the time where you have a tech trend that comes along once every 5 to 10 years that you can really lever up your portfolio in terms of exposure and benefit from it. So what are the next two names on our list, right? We've been rounding this out with 2 picks every week. We're in the 5th week. Would you hurry up and finish already? I know some of you are saying, just give me all the picks and go home and shut up, Lou. But, well, here we go. We get the last 2 picks, Tempest AI. Now, if you're not familiar with Tempest AI, this is a company that's got about a $10 billion market cap. It's rapidly growing, and it's created a positive flywheel effect for any of those business school MBA graduates that ever had to read Good to Great from, that book. That's Jim. I can't remember his last name. It doesn't matter. What's important is what this business has built. They started off with a testing business, right? Genetic testing, cancer, other genetic tests, and then they started aggregating that information to develop a multimodal model, which means multiple inputs. It can be clinical, it can be personal. It's personalized medicine to apply AI to and then license that. So they anonymize it and then license that to pharmaceutical companies developing drugs. So think about this. They started out with a single business that's generating over $500 million in revenue, found ways to expand into other adjacent markets, into drug development, into AI licensing. And this is a play that could have a lot of legs. Yes, people are going to argue over the valuation. It's too richly valued. But guess what? People argued over Nvidia's valuation, including yours truly, in the early days of that run. But those stocks, just like Nvidia, just like Tempest they can grow into that valuation. I think that's the potential here for Tempest AI. So as we've shared, with Core Scientific, and then also Symbotic, our robotic and AI play, the warehouse automation play that's up 40% almost since we recommend it. Don't sit idly by as we put a new stock on your radar. Go do your diligence. Go spend a little bit of time. Use AI to do some of your diligence too. I don't care. Use ChatGPT and say, give me the investment thesis for Tempest AI and ignore any comments from Lou Basenese and go get the comments from other people. You'll see that it's very rational, straightforward momentum play in a red hot market with tons of spending that's buoyed behind it. And it's a first derivative, second derivative play that's based on a legacy business. So this is not a new AI startup. This is a business that's been around, it's thriving, and now found a new way to thrive exponentially more. So that's Tempest AI. Now let's go to the other side of the spectrum. Let's go to a completely new business launched in the last year onto the public markets. It's Exozymes. I'm conflicted here because I worked for the investment bank that brought it public. I helped raise the IPO, but I don't care, right? Conflicts of interest are a good thing, as one mentor told me. Now, what does Exozymes do? Well, Dan talked about the fourth industrial revolution. I'm going to go out on a ledge here and predict the fifth industrial revolution, except it's not going to be in the physical spaces that we interact in. It's not going to be physical AI in any sense. This is really a cellular industrial revolution. This is, if you've heard of synthetic biology, which was a huge boom and bust trade, this is the next generation of that. Instead of being limited by cells, it's going to use the enzymes that catalyze reactions and produce very valuable compounds to manufacture whatever we can think of, right? So you can, nutraceuticals, pharmaceuticals. This is a company that went public and ran as high as about 18 or 19, just close to $20 per share. So it's had a track record of being at double the price. They've really developed science, enzyme-based science, catalyzed processes that can make things that we can't make in abundance, right? Think about cannabinoids is a good example because there's, the endocannabinoid system, there's probably, think of antioxidants, there's over 140 just different cannabinoids that are found naturally in the marijuana plant. Now, some of those are extremely hard to harvest, so we have no idea about their potential pharmaceutical benefits. There's other examples of this in the natural world of plants that can produce nutraceuticals, but just harvesting them is really difficult. Now, imagine if you could recreate exactly, completely, and synthetically, or in a vat, in a lab, endless supplies of that is self-catalyzed and continuous and continues to run. Well, that's what you have with the potential of Exozymes. It's an industrial manufacturing plant for biology. They call it biomanufacturing. It's all caught up in keywords that no one can make sense of. Let me make sense of it for you. This is the real deal when it comes to synthetic biology, at least in the lab, and it's proving it can scale, which is what the limiting factor was for the original first-gen synthetic biology companies. It's also proving that it can attract non-dilutive funding, and lots of it, from various government agencies. So people way smarter than you and I have spent their entire years working on these enzyme-based reactions and catalyzed systems, and they're working for the government's largest agencies, and they're putting their capital behind it. So back when we were bringing the company public, when I was an employee of MDB Capital, I did a key opinion leader call with one of the founders, Tyler, and then also one of the lead scientists from the National Renewable Energies Laboratory. I can't remember the acronym. I'm trying to pick it out of my brain, but it's not there. Go find that online. you'll get a better understanding of the big potential here and why it's been added to our list as the last and final, well, almost final, because Core Scientific is getting acquired, right? So we've got to come up with a replacement for number 6. So alas, folks, you're not done with my top 10 AI stocks not named Nvidia yet. You've got one more episode to bear with me on. At this point, I'm gonna call an audible. I'm going to call in the Dodd man, who usually comes in the D block, the Dodd block, to come in the C block. And let's run through some of these names, because for people that haven't been listening, for people that just joined because Dan Ives was joining the podcast or because they saw that we were going to talk trash about Tesla perhaps, they might not be aware of the other names that we've talked about. So I think you might have some questions, because you're usually the one that keeps me honest here.
Well, first of all, I want to say, man, this is what the C block looks like. This is pretty cool. Great.
Yeah, glad to have you. Don't get used to it. The summer internship's almost over, my friend.
Yeah. We'll hear that. I was thinking, first of all, victory lap on Core Scientific, brother. Nice work there.
Yeah.
I think, I was looking at all these names and really had some questions. I was asking, which ones would, are best for me to invest in, and of course, our viewers. So
yeah, no, don't buy any, because it's someone tweeted out today. I think it was Ian Castle, who we've had on the show, tweeted out, like, if you want to watch a stock go down, just tell your friends and family to buy it. That's pretty much what always happens. So
I've experienced that once or twice. I actually know that. So anyway, which of these AI stocks do you think could double first, and what would trigger that kind of move?
What could double first and trigger that move? I think it's something on the smaller side. So it's a Gain Therapeutics or an Exozymes, right? So Exozymes, we just showed, had actually already traded at double its current price. I think on an actual business development deal where there's dollars coming in, not non-dilutive government funding, it could easily double. The float's really small there too. Gosh, I can't remember offhand, but it's less than 10 million shares available in the float, which means the more buying that comes in, the more pronounced the upside move is. Pookie's Revenge coming in with the scientific
Pookie's
dropping
back.
Knowledge on us again. Pookie, where have you been, my friend? We missed you
you've been
for a
gone
few
for
weeks.
several episodes.
Enzymes are such an underexploited pathological component. Amen to that. I think this is the next frontier of drug development, and also just massive development, right? We think about personalized medicine and tapping into the immune system's natural ability, how to activate that to fight disease. I think enzymes catalyzing all types of processes to produce products are what we need. So for Exozymes, it could easily double on a partnership announcement, getting commercial, right? That's the key. When you get an early stage company that's pre-revenue, you need a deal that's going to get to revenue, show the path to market, and it can't be a long one. You could, Exozymes has the potential, and they're doing deals in the space in terms of development into biofuels, but that's years down the road. You need something that's near term that could double that. And then Gain Therapeutics, we talked about last week, is using machine learning and AI to develop drugs, small molecule, so pills, to treat degenerative autoimmune diseases. And right now, they're in a trial for Parkinson's disease. Early data has been encouraging, animal data, so that's the disclaimer. That's actually not just stopped the progression of Parkinson's in mice, but it actually reversed it. Now, if you can do that in humans, watch out. This is a $16 stock, 5 to 16. I think last week we shared Societe Generale, improper pronunciation, but you get the point. Their research report, I think they had a $16 price target on it. Mm-hmm. So those are the two that can move the fastest and the most. But guess what? It means they're the most risky too. So do your own research.
Well, okay, so Core Scientific just got acquired. What would be the next one on that list that you think could be acquired, and by who?
Why you gotta ask the hard questions? Why can't you have easy things, man?
Not here to make your job easy, man.
Yeah, I don't know. I mean, takeovers are notoriously hard to predict. I think in Core Scientific's case, it was very easy because the industry, let me put it this way. Industries that are consolidating continue to consolidate, right? It's just the urge to merge intensifies when you remove one of the competitors and roll it into another one. Looking at this list right now, I mean, maybe in Astera Labs, it's newly public. It has a critical chip and software overlay that would make it attractive for maybe an Nvidia. It plays nice with Nvidia. It's built to work with Nvidia. Their interconnects work. So I'd have to go with Astera. Innodata definitely couldn't be acquired because they're doing deals with all the major AI players providing data services. So it would create a weird conflict of interest if Alphabet tried to acquire them, yet Microsoft and Apple and Amazon are clients. Oddity tech, I mean, that could be an oddity. We've talked about that one before. That's actually using AI to develop personal products, consumer brands, and going very well. One of the cosmetic brands is one of the best-selling brands in the country right now. I could see that maybe getting rolled into a more mature company that's looking to diversify into AI. But yeah, I'd say Astera Labs. I'm going with Astera. That's my last and final answer.
We'll have to come back and look at that in the future and see if you got it right.
Yeah,
Right,
or we'll just delete this
but-
episode from the archive if I was wrong and it was something else. So that's all.
Last quick question. You don't need to explain, but back the truck up, Lou Basenese fund. Which one are you picking?
Ooh, back the truck up. You mean tell people to do exactly what I advise against, to go into one name?
You know what I mean.
Yeah.
Which is the sure bet, you think?
There's no sure things in the markets, right? If I look at this list, I'll give you two sure bets. One sure bet that's not going to blow you up is Symbotic. It's got a backlog that's as big as market cap. One sure thing that could blow you up and put you eating at, Denny's on a trip to Vegas instead of fine dining in a steakhouse it's going to be Gain Therapeutics. I think that it's a biotech. It's binary. No pressure. Thanks, Pookie. I waited full porting into Astera as we speak. All right, buddy. Way to go. Way to vote of confidence and not to do your own due diligence. Well, you know what? It's been fun. Top 10 AI stocks not named Nvidia. We've had one that's already been taken over, another that's ramping as we speak. Let's see where the rest of them perform. But before we do that, we got to take a quick break for one last word from our sponsor before we come back and bring you back to the D block, man. Double duty today, Dodd. Lots of D's and alliteration, my friend. So we'll be right back after this quick break. Business moves fast, and so does search, especially now with AI transforming how customers find you and your business online. If your business isn't optimized for AI-driven search, you're completely missing opportunities every single day. Now, that's where Ascend Media comes in. They're more than marketing. They're strategic growth partners that use advanced answer engine optimization, cutting-edge SEO strategies, and proven business analytics to help your company generate new leads, attract more customers, and solidify your brand's experience and presence. In the era of AI, visibility equals profitability, and Ascend will ensure your business stays ahead. Visit Ascend Media today, ascendmedia.com today, and don't forget to mention the Big Skinny to get your sweet Lou discount. It's actually a free SEO performance audit. With Ascend Media, your growth is just a click away. So don't miss out. We'll be right back.
He says, Lou. Those small caps are going to struggle, but Lou, you were a believer
I know,
in those
I know.
pint-sized companies, so
Listen.
make your case.
Small caps are the Rodney Dangerfield of finance. They get no respect. And look, I've been banging the table there for a while. I've been early and wrong. So full respect, you've been right on that. I do think there are pockets. You got to look at undervalued revenue producing ones. There's a lot, particularly in the biotech space, that fall into the Russell 2000 that don't have any. So I think, again, you got to be a stock picker. One thing I will add to Kirsty that I agree, another data point here for the earnings season that really sets the stage for better than expected performance is that we saw 51 of the S&P 500 companies raise Q2 guidance, right? Even in the face of this tariff tantrum, you're seeing companies be more optimistic about their ability to absorb that and not impact margins. So I think the stage is set again for that 7% expectation in Q1 that showed up as 12%. This quarter it's 4%. Is it 8%? We'll see. All right, buddy, we're back. Welcome back to the Big Skinny, where we come to our segment called High Five, where we either high five each other or smack each other for being wrong, right? We got 5 in under 5 minutes to cover here, so we might be able to rename this 5 under 5. What are we doing here?
This is easy. Fed, forget about it. So this has got to be about the
Forget about it. Hey.
I'm guessing this is Dan Ives rolling through Brooklyn, picking up bigs or something. His big checks.
No,
Sounds a little, yeah.
It's forget about the 25 basis point coming in July. Everyone got excited because ADP payrolls were weak. The Labor Department's payrolls were not. If you look at the probabilities here coming from Yahoo Finance, coming from the Fed Watch tool, there's next to no chance. I think it's like a 95% chance of no cut at this month's meeting. You got the first cut maybe coming in September, but there's a lot of movement there too. I say probably not in September either.
It's been a long, just hurry up and wait.
A
Hasn't
long
it?
September, isn't that a Counting Crow song?
It is.
Yeah, yeah.
All right.
Ding, ding,
Bulls.
ding. Trivia.
There you go. Bulls back. Not a Michael Jordan story, I'm sure. It's got to be the bullish sentiment of stocks rallying. Right?
Yeah, the Knicks are back. The Bulls are not, but this is bullish sentiment. Remember, this is a contrarian indicator that we've tracked early on, and when all the malaise and sell-off was going on in the market, we showed that bearish sentiment coming from the AAII survey was over 50% for, I think, 13 or 14 weeks in a row, which was unprecedented. Now we're seeing bullish sentiment pick up. It's at 45-ish% in the last reading here. That was up from 35%. Remember, here's the key, folks. If you weren't paying attention to previous episodes, anytime bullish sentiment drops below 20%, it's an absolute buy signal. There's only been one out of, I think, 37 times in the markets when it drops below 20 that the stocks aren't higher 3 and 6 months later. So it could be a contrarian indicator now, like too much bullishness. Maybe we take a breather here, but I don't see it. I think
you might need to write a special something ditty for that, like, when the bullets fly, time to buy.
Yeah, that's a good one. Good on you for remembering that. Hey, don't forget to join the conversation. We got a few moments left in our show, 3 more to go through in under 3 minutes, but that's not too short of amount of time to fit in some questions. Could you please explain the correlation between market cap and enterprise value differences of a stock? Man, you got to go back into my MBA days. Look, here's the easiest way to think about this. Market cap is just simply number of shares outstanding times the market price, right? That's your market cap. So what does enterprise value do? Enterprise value tries to think about what's the whole enterprise worth. It takes out cash on hand and adds back debt, right? So that's what you have to do is you take market cap minus cash, add back debt, and that's the total value of your firm. So for instance, take a company like Prairie Operating Co., my employer, we're at about $160, $170 million market cap, but close to a $750 million enterprise value because we have close to $400 million in a reserve-based lending loan from the likes of Citibank and Bank of America. So they obviously see a lot of value in the assets that we have, and therefore in certain industries, enterprise value is a better measurement of the true value of a firm. I broke that down in Chicago and gave some people some headaches. All right, Pookie. Yeah, we were in Tradies Paradise. If any of those folks, lovely folks that I got to meet and spend 4 days there with in Chicago are listening in, thank you for joining this show, and thank you for your just candor and support. So we love hearing your comments, even if we end up confusing you more with our answers. But that's not the goal. What's next, Todd?
Credit card concerns.
You got them?
Yeah, I mean, everybody does. I'm sure.
Yeah, tough life for an intern. You can't put it on credit, and they didn't give you a big, skinny issued credit card yet. No, listen, there's been a lot of noise about the consumer and waiting for the consumer to just break and fracture and stop spending so much to drive this economy. And for a while, everyone was focusing on delinquency rates on credit cards, but I think they've peaked. This coming in from Torsten Slock out of Apollo, showing the credit card delinquency rates 90-plus days by age group. Obviously, the top, I'm losing my vision, but I'm pretty sure that top line is the youngest group. The cohort of people that probably shouldn't have credit cards. What 18-year-olds have their own credit cards? It wasn't me. But anyway, I think we're out of the danger zone. People can stop freaking out about this. We showed a couple episodes ago that consumers actually have never been in a better spot. You can't just look at absolute terms of debt. So if you look at assets versus liabilities, we have about $20 trillion in assets versus about $2 trillion in liabilities on consumer household balance sheets. So 10x more assets than liabilities. Consumers just fine, going to keep on spending.
All right.
Let the good times roll, my buddy, but just not on the credit card.
Yeah. And my 19-year-old has a credit card, but that's all just about building.
Sounds like you got to have a family talk today, buddy. She's also an entrepreneur, though, so yeah.
Swing and a miss. I know what this one is about. We're talking about your haircut, right?
Yeah. Boom, boom. I tried to match yours, my friend. Swing and a miss. ADP jobs report showed a negative 33% contraction in jobs. It's normally just dislocated from the labor departments, but this was huge. I mean, this yellow dot is ADP's estimate. Guess where the actual number came in? These red bars are the analyst estimates. Came into far right. The actual number was like 147,000, if I remember correctly. Note to self, ignore ADP at all costs, at all times. It's completely irrelevant and made more so now than ever.
I could have done that.
I know. Just throw random darts at the wall. Draw pretty pictures. That's what you're good at, right?
Exactly. Profit problem. No idea what's coming, but I can relate.
Profit problem. Why is it always? Oh, yes. I always forget on the last one, man.
It's the last one.
It's
You
always the
never
last
lose
one. No, we've been talking about small caps and how they're poised to grow. Last week we showed the chart where they're going to go from 18% profit growth in 2025 to 37% in 2026. Here's a chart that shows that the Russell 2000 has the greatest percentage of unprofitable companies at 46%. If you look at the mid-cap index, it's only 17%, and 93% of companies in the S&P 500 are profitable. The only 7% are unprofitable. Here's the thing. Yes, there's a lot of unprofitable companies in small cap world. That's largely because 20% of that index almost is biotechs, which don't generate revenue while they're small caps. Once they get good data, they graduate out of there. So that's really closer down to about 30% that are unprofitable. But that's what you get in small cap territory. You're buying story stocks as well as companies that are in early stages of growth. Doesn't concern me. It's not a profit problem. I think it sets up a profit opportunity. So counter-cultural, counter-thinking, and we're 1 minute overtime. Send me to the penalty box. Get out of here. ADP is the weatherman of the financial world. Yes, he is or she is. Nowadays, there's weather men and weather women, but you're absolutely right. Ignore it at your own cost. Ignore making predictions way far out in the future. It's really hard to do, even though we made a few of those today with Dan Ives. AI is taking over our jobs in the world. Bet on it now so you got plenty of money to spend in your boredom when you're out of work. And we're out of time. So Dodman, Dan, Taylor, and all of you, thank you for joining in this week, episode 15 of The Big Skinny with Lou Basenese and friends. We'll be back next Monday, 5 p.m. live from Brooklyn. Lou Basenese, signing off.